Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about SANY Heavy Equipment International Holdings Company Limited Annual Report. SANY Heavy Equipment International Holdings Company Limited offers a diverse range of businesses and services across various industries. The company operates through four main segments: mining equipment, logistics equipment, oil and gas equipment, and emerging industry equipment. In the mining sector, SANY provides coal and non-coal mining machinery products, mining transport equipment, spare parts, and related services. This includes intelligent excavators, mining machines, and smart mine products such as automatic integrated mining and unmanned driving systems. The company also offers robotic solutions, including robot system integration, mobile robots, and electric forklifts. In addition to mining equipment, SANY provides logistics equipment such as front loaders, stacking machines, quayside gantry cranes, grippers, elevated hoisting arms, heavyweight forklifts, and telehandlers. The company also offers drilling, workover, and automated pipe handling equipment for the oil and gas industry. Furthermore, SANY develops intelligent application scenarios based on industry practice and development needs for transformation and upgrade of electric, smart, and unmanned production. This includes property development services, automation equipment, monocrystalline silicon materials, and hydrogen production, storage, transportation, and refueling industry chain activities. The company's services also extend to the oil and gas sector with frac spreads, oil and gas field cementing and stimulation technical services, Li-ion battery manufacturing equipment, solar modules, and electrolysis hydrogen production equipment. SANY operates globally in mainland China, rest of Asia, Europe, the United States, Brazil, Africa, and internationally. SANY Heavy Equipment International Holdings Company Limited maintains a market capitalization of $39 billion, broadly in line with the industry peer group. SANY Heavy Equipment International Holdings Company Limited trades at a higher price-to-earnings ratio of 22 times and a higher price-to-book ratio of 2.67 times relative within the industry. This makes the stock appear much more overvalued compared to its peers. However, the broader industry is also trading at elevated valuation levels, suggesting sector-wide optimism rather than company-specific overvalue. Investor should evaluate if the stock is worth its premium price. The leverage on the balance sheet appears elevated, with liabilities of 70% of total assets. This raises some concern, and we should examine the industry and nature of the business to determine whether they justify the elevated leverage. Liabilities have grown faster than assets in equity, which is somewhat concerning. However, asset growth remains positive, suggesting management may be temporarily leveraging liabilities to fund expansion. Shareholder equity has expanded consistently over the past 5 years, with growth supported by rising operating income. This suggests the company is profitable and financially sustainable. The share count has increased over the past 5 years, while revenue has continued to grow. This suggests the business may rely on shareholder dilution to fund expansion. Investors should closely monitor whether growth can eventually be sustained without dilution. The company have a dividend yield of 2.98%. The income statement shows that the company have been growing its revenue annually and the operating income have been increasing. This shows that the business model works and the business is expanding. The primary drivers of revenue growth or decline are multifaceted and influenced by various factors. On the growth side, globalization has been a significant contributor, resulting in an 11.1% year-on-year increase in revenue. International sales have also played a crucial role, with a 13% year-on-year increase in international revenue across different product segments, such as mining equipment and logistics equipment. The emergence of new industry segments has also driven revenue growth, particularly the sale of industrial products, which saw a significant increase of $9.2 million from 2023 to 2024. Additionally, the introduction of new revenue streams, such as the sale of electricity, has contributed to overall revenue growth. The acquisition of lithium energy business in July 2024 is expected to further boost revenue. On the other hand, certain segments have experienced decline in revenue. The mining equipment segment saw a 2.1% decrease, while logistics equipment segment declined by 6.3%. Geographically, the United States of America witnessed a significant decline of 28% in revenue. Furthermore, a decrease in gross profit margin due to an increase in proportion of products with lower margins has also contributed to revenue decline. The net income of the company underwent a significant change between 2 years. Initially, it decreased by RMB 72,112,000 due to an impairment loss. However, in the subsequent year, there was a substantial increase of approximately 61.5%, with the net income rising from RM 101.6 million to RM 778.8 million. The profit margins also experienced a notable change. Although no specific comparison is made between 2024 and 2025, it is mentioned that the profit margins before tax increased by approximately 2.5 percentage points, from 6.5% to 9%. This indicates an improvement in profitability for the company over the 2-year period. The company's financial performance indicates a positive trend in its operating cash flow. According to the provided information, the net cash inflow from operating activities has increased significantly from RMB 2,152.1 million in 2024 to RMB 2,457.1 million in 2025. This increase suggests that the company is efficiently managing its operations and generating sufficient cash to cover its expenses. Furthermore, the operating cash flow for 2025 is reported as RMB 1,432,111, which is a positive figure indicating that the company is generating more than enough cash from its core business activities. Overall, these numbers demonstrate that the company is on a path of financial stability and growth, with a notable increase in its ability to generate operating cash flow. The company's financial health has undergone significant changes over the past year. A notable increase in debt level is evident, with total debt rising from RMB 9,934,599 in 2024 to RMB 11,060,721 in 2025. This upward trend is also reflected in interest-bearing bank and other borrowings, which have increased by a similar amount. Consequently, the company's interest expenses have also seen a substantial rise. Finance costs for the year ended December 31, 2025, stood at RMB 152.9 million, a significant increase from RMB 128.6 million in 2024. Furthermore, interest expenses have jumped from RMB 62,627 in 2024 to RMB 70,413 in 2025. These changes indicate that the company is shouldering a greater financial burden due to its increased debt level and associated interest expenses. The company's performance can be analyzed through its various segments and regions. On the positive side, the emerging oil and gas industry has been a standout performer, with significant segment results and revenue generated from this sector. Additionally, large port machinery and power battery have also shown promise, although specific metrics are not mentioned. International markets have been successful in terms of expansion, indicating a growing presence globally. The lithium energy business, acquired recently, is expected to contribute positively to the company's performance going forward. On the other hand, some segments have underperformed. The logistics equipment segment has reported significant losses, with negative segment results and revenue. Similarly, the mining equipment segment has also struggled, with a substantial decline in segment results despite decent revenue generation. Management is emphasizing the company's commitment to its workforce, highlighting several key initiatives that demonstrate their investment in employee growth and well-being. Firstly, they plan to continue investing in talent development, which suggests a focus on building internal capabilities and fostering a culture of continuous learning. In addition to this, management has announced plans to reward staff with year-end bonuses, providing a tangible incentive for employees' hard work and dedication. Furthermore, the company is offering share award and option schemes for core employees, which not only provides a financial benefit, but also aligns employee interests with those of the organization. Finally, management is taking proactive steps to mitigate potential risks by monitoring and potentially hedging against foreign exchange risk. This demonstrates a forward-thinking approach to managing the company's finances and ensuring its long-term stability. Overall, these initiatives convey a sense of confidence in the company's future prospects and a commitment to supporting its employees as it continues to grow and evolve. The company has a history of paying out dividends to its shareholders. In fact, it is evident from the provided information that the company has consistently paid dividends in recent years. On page 20, it is proposed that the final dividend per ordinary share be HK$0.35, which suggests a commitment to returning value to shareholders. Further evidence of this can be seen on pages 37 and 39, where it is explicitly stated that the company has indeed paid dividends, with the amount being $0.35 per ordinary share for the final dividend. This demonstrates a clear policy of rewarding shareholders through regular dividend payments. There are concerns about inventory buildup or supply chain disruptions at the company. The elimination of intersegment receivables and payables on page 9 indicates a potential issue with inventory management, suggesting that the company may be holding onto too much stock. Furthermore, provisions against slow-moving and obsolete inventories on pages 10 and 12 indicate that the company is recognizing losses due to unsold or outdated products. This suggests that the company's inventory levels are not being managed effectively, leading to waste and potential financial losses. Additionally, an increase in raw materials, work in progress, and finished goods inventory on page 22 indicates a buildup of stock, which can lead to further problems if not addressed. The significant increase in inventory turnover, days from 94 to 100 and 8.5 days on page 35, also suggests that the company's inventory is not being sold or used efficiently. Overall, these indicators suggest that the company may be experiencing supply chain disruptions and inventory buildup issues, which could have serious financial implications if left unaddressed. That concludes the financial summary for SANY Heavy Equipment International Holdings Company Limited. Feel free to comment below, and I will be happy to answer them when possible.